Welcome everyone, this is Santosh Pasi and welcome to Options Strategy Trading Basics. This tutorial will help you to understand about options. This will cover basic stuff like terminologies, basic Greeks, so that you're ready for the options trading workshop. So in case if you have enrolled for my workshop, I would request you to go through this tutorial and this will help you to get ready for workshop. Before we go through this tutorial, these are my disclaimer and disclosure, so just read it before you move forward. Okay, so in options basics we're gonna cover options terminology, then we'll see about option premium, then why we should do option writing, then we will touch base historical volatility, then we're gonna go through implied volatility, then we would try to understand Greeks like delta, gamma, theta and vega, and then we would try to go through very briefly on support and resistance. These are just few basic stuff, but once you go through the workshop we go in deep dive. Here I'm just gonna cover basic stuff. Now if you go to any trading market, then uh, your secondary market here, so we have different components like a cash, future and options. So normally future and option we call it a derivative market, and cash may be a secondary market. Okay, and in derivative markets under futures and options, we can trade maybe commodities, maybe just uh, currencies as well as your equities. Now in options we do trade using calls and puts, versus in case of future it's just future, in case of cash it's just a share. Now before we start actually into option, we must understand the difference between the cash market versus future market and the options market. So if you go for the cash market, there is no limit as such, so you can start with just as good as single share, versus in futures and options, as those are derived product controlled by the your exchange, then you have to trade in the lot size. There is a predefined lot size by exchange and you need to follow that. In case of a cash market, you become a shareholder of the organization, versus in case of derivative markets, you are not the shareholder because you are not part of their shareholding pattern or their shareholders. Then in case of a cash market, as you are the shareholders, you're gonna receive dividends, bonus, rights, and other benefits. Those things are not possible in case of FNO. In case of cash market, there is as such no expiry date, so you can keep your shares as long as you wish. Versus in case of future and options market, there is a predefined expiry, so the trade needs to be squared off before that. And in case of a cash market, it may not be a risky product as compared to future and options. And in case of a share market, as told you, it's you can keep it for lifetime. It's suitable for the long term investors. Versus in case of FNO, it's suitable for traders, and you need to square off your positions before at expiry. Cash market, there is no leveraging, versus in case of future market you have a certain level of leverage that's available, and in case of options it's even further highly leveraged product. So as it is a leveraged product, you will have higher returns, at the same time you'll have a higher risk also. And cash market, normally I call it a 1D market because generally people will trade keeping a bullish view. Versus future market, I normally call it a 2D market. That means you can earn in both the direction, where the market goes up or market goes up, provided you are in the right direction. And in case of option market, I call it a 3D market because you can earn when market goes up, you can even earn when it goes down, as well as you can earn if it is a sideways. So you can make your strategy and that can work in all these three different trends. Let's just go through what is options. Okay, so options basically it's just a contract that gives the right but not an obligation. Now, if you consider future market, right and the obligations go hand in hand. Versus in case of options market, those are two different things. So if you're buying the option, then you get the right, versus if you're selling the option, then you get the obligation. And as I told you, option is a highly leveraged product, so you have to pay a small fraction of the underlying asset value to do the transaction. So that is known as option premium. So let's take the example. If Nifty is trading at say 10,000 and lot size is 75, so that is even if you go for one lot, so that's 75 into 10,000, so that would come up around 7 lakhs 50,000. Okay, but you need to pay just maybe around 60,000. So that's small. You are just paying around 8 to 9% of the total underlying asset value. So the small premium that is known as options premium. So this is the amount that you need to pay to do the transaction. And in case of option market, there are two types of options are there. One is called call option, and the other one is called put option. Now the call option basically, or the normally people will say it's a bullish, but the right definition is that it gives you right to buy the underlying at predefined conditions. Okay, versus put option, it gives you right to sell. Okay, at predefined conditions. So call is nothing but it gives you right to buy, and put gives you right to sell. So let's take the example. For example, let's say you want to buy a say a flat, very small flat, maybe 1 BHK flat, and you go through those initial process, and then you have decided that you want to buy a specific flat in certain location. Okay, and then you go and you meet your builder. Now builder may say, yeah, this particular flat would cost you around 50,000, and initially you have to pay maybe a 10% as a booking amount. So once you pay say 5 lakhs in this case, then you will receive a receipt from the builder, and that receipt is nothing but that is a right to buy. So that receipt will give you right to buy a flat of 50 lakhs rupees, maybe a 1 BHK flat, that's your underlying asset, and maybe within 3 months you need to pay remaining 45 lakhs rupees to the builder. So that is nothing but that's a right to buy. Now let's take example. Today is first of the month and you did this transaction, and maybe immediately on 5th of the date of this month, there is some good news. Wherever you book the flat, maybe some metro station is coming up in that particular area, so obviously your flat value would increase, but your builder won't ask you the higher cost because he has agreed, because you have the right to buy at 50 lakhs, so he won't be able to ask you for the higher prices. So that is nothing but that's a right to buy. So you have a right to buy a flat at 50 lakhs rupees. You have already paid a premium of 5 lakhs rupees. The underlying asset in this case is my flat, and my expiry is for the flat transaction or contract is 3 months. Same way, if you're going for put, that gives you right to buy. So let's take the example. Is that there are a lot of examples are there. People may give you example of like agriculture product, maybe if you guys may give you the example of like insurance products. Let's take the example here. I'm gonna give some new example. Let's consider if you want to open any restaurant in your area, then first you have to apply to your municipality or maybe your local house over there, and you need to get the permissions or you need to buy a license. So to buy a license you have to pay a small money to the government body, and once you pay that small money, that's the license fee, you actually get right to sell your services. Okay, so you have to pay some small money so that you get right to sell. So in case in this particular example we get right to sell my hotel services. Okay, and the small money, the license fee, that is nothing but that's my premium. Now in case if you're buying an option, then you would be known as a buyer or maybe the owner or the holder of the rights. versus the counterparty on the option seller or the writer. Okay, so and they will always have obligations. So rights means you have the choice or you have the option. So that's the reason this is called options trading. Okay, and the option writers, the other counterparty, they have the obligation. So whatever option writer asks, they have to follow that. Now you might have seen this option chain page. That's an essay option chain page, and on the right top you can see that we have underlying asset, and you can see that the realistic price is 7713, and at the central you may see a strike price over here. So that's my strike. Different strike prices are here, and on the left of the strike price, all this data is for my call options, and on the right hand side is data for my put options. Okay, as you can see, two different colors here. The yellowish color, that we call it in the money, the white colors we call it out of the money, and at the money, where one yellow and white meets, that we call it the at the money. Same is case in for the put. So these yellowish colors are known as in the money, the white colors are out of the money, and where yellow and white meets, that we call it at the money. Then we have here different columns like open interest, change in the open interest. Then we do see the volume. Then the IV stands for implied volatility. Then LTP, that's last trade price. Then net change in the price. Then we do have a bid quantity, bid price. Then we have ask price and ask quantity. As I've already told you, call is nothing but it gives you right to buy, and put is gives you right to sell. Now let's take one example here. So in this particular example, Nifty is nothing but that's my underlying asset. 28 Jan 16 is my option expiry date, and 7500 is my strike here, and C stands for call European. So in options world, we have two types of options. One is called European option, the other one is the American option. So the difference is that in case of American option, you can exercise your right. Right here is like right to buy or right to sell your underlying at any time before the expiry or on the expiry, versus in case of a European, the exercise can be done only on expiry. So in other way around, let's take the example of flat. Okay, so exercise means taking a possession of the flat. So in case of American, I can take a possession of flat before the expiry, anytime before now and within the expiry, versus in case of a European style, I can get the possession of flat only on the expiry. Now let's move to the next topic, and that's strike price versus and the expiry date. Now, as you have seen the option chain pair at the center, we have the strike price. Example like 7,000, 7,100, 7,200, 7,250, and blah blah blah. So that's the strike price where we agreed to get the right. Okay, and here you need to just keep a watch on the illiquid strikes. So like in case of Nifty, illiquid strikes are those that ends with 50. Example like 7,150, 7,250. Those are my illiquid strikes, and that should be actually avoided, because as it is illiquid, there would be a higher bid-ask spread, and sometime if you want to square off your position, that would be a difficult one. Then expiry date. So in Indian market, normally expiry is on the last Thursday of the month, as well as we do have expiry on the weekly basis. That's for the Bank Nifty and the Nifty CPSE. Now let's go to the next topic. That's the money names of the option. As you have seen in my earlier example, that's what on the page. So the ones in yellow color, those are my in the money. The ones those are out of white color, those are my out of the money, and that is OTM. And at the center we have the at the money options. So in case of the call options, if my strike rates are lower than the last traded price or the spot price of underlying asset, then those are known as in the money. And the strike price which are higher than my underlying asset value or the spot price, those are known as out of the money. And well, technically if my strike price is equivalent to my spot price, then those are known as at the money. In case of a put option, we will go the other way around. So here my strike price has to be higher than the spot price, so those will be known as in the money. And in case my strike price are lower than underlying ATP or last rate price or spot price, those would be known as out of the money. And wherever one white and one yellow mix-ups, those area we call it at the money option. Okay, so generally in the money will have higher values, as you can see here. After the money options, they will have lesser values. Same in the case of put. So in the money will have the higher values, as you can see here, will be costlier compared to out of the money options. Now let's go to in the example over here. So as I've told you, at the center we would have ATM, so that's the ATM for call, this would be ATM for put. Then we do have in the money, we do have out of the money. And then people may use different terminologies like deep in the money or very deep in the money. So those are away from the spot price, so this would be in the money. The further away, that would be known as deep in the money, and if you go further away, then that would be known as very deep in the money. Similarly, the case of OTM, so this would be the OTM. So if you go further down, then that would be known as deep OTM, and if you go further more down, so in that case those would be known as very deep OTM options. So normally we avoid trading the deep OTM options, so that can be used only occasionally for your insurance purpose, but most of the time we do avoid deep OTMs. So we prefer to trade either at the money or near in the money or maybe OTMs. Now in case of share market, normally we buy things and then we sell things. Okay, so same way in case of options market, you may buy the options or you can sell the options. So in case if you're buying the option, let's take the example of builder transaction. So there we were buyer of the options, so we have to pay a money to the builder. So that in case of long options like long call, long put, we have to pay premiums. In turn we get rights to exercise. Here right could be right to buy or could be right to sell. Now when you're buying things, okay, then like long call or long put options, you have risk is limited, so that's a limit to the money that you have paid to the builder. Like in builder example, so you can lose at the most 5 lakhs rupees, so that's the only limited risk. Versus my reward is unlimited, so my flat cost can increase from 50 lakhs to 60 lakhs, it can go to 70 lakhs, it can go to 1 year, so my reward is unlimited. Now let's consider the builder case. So builder, as a builder, if you're shorting, builder did shorted the option, so he will receive the money. So assume that we are builder, so we would be receiving the money, but in turn we get the obligation, and that obligation is to settle. Okay, for the risk, it would be unlimited because my as a builder material cost can increase. So same way if you're shorting the option, your risk is unlimited because let's say the flat cost increase to 60 lakhs to 70 lakhs to 1 year, still he is gonna receive a limited reward. So for him the reward is limited versus his risk is unlimited because material costs, labor costs, maybe government taxes can increase. So in case if you're shorting the options, you will receive the premium, but you will get the obligation, and your reward will be limited and your risk would be unlimited. So on the nutshell, if you see this screen and you just compare long option versus put options, normally on theory it looks like long options are better because you have a limited risk and you have a unlimited reward, versus in case of shorting option, reward is limited and my risk is unlimited. Okay, but when you consider your property market, you'll find that most of the time the builder mm, is in business and is always profitable compared to the buyer. Okay, so we would recommend in the Indian scenario there are certain reasons are there, some conditions are there. So we normally recommend you have to focus on shorting an option rather than going long. So once you join our workshop, we will explain you the further technical details why you have to go for uh, shorting instead of going for a long options. Now, in case of options, you can't just do a long option or short option because we do have a call and put. So I can go for long call, I can go for short call, I can go for long put, I can go for short put. So in case if I go for long call or long put, my rewards are unlimited and my risk is limited, versus if I'm going for shorting a call or shorting a put, my risk is unlimited and my reward is limited. Now, if I'm going for a long call, my market outlook is bullish, and if I'm going for long put, my market outlook is bearish. Versus if I'm going for short call, my market outlook is sideways to bearish. Versus if I'm going for a shorting a put, my market outlook is sideways to bullish. So technically, we may even call this shorting a call as I am not bullish, and shorting a put we may call it I am not bearish. Okay. Now here, if markets are cheaper, here markets cheaper means not the underlying but my options market or derivative markets. Then we prefer to go for longs, versus if my derivative markets are expensive, then we would prefer to look for shorting opportunities. So based on underlying um, derivative values are not actually the underlying value but the derivatives premium. If my premiums are cheaper, then preferably go for longs, and if your premiums are expensive, then go for shorting options. Now, as I told you, we focus on writing options, so you have to understand what are the good things about writing and what are the bad things about writing. So, if you're shorting, then you do receive a premiums, and believe me, this is the real premium. Using that premium, you can actually buy insurance or some other things. And at the same time, if you're writing option, so time decay is in your favor. So, what you're gonna earn, the same thing would be loss to a buyer. Okay, so every day options, they will reduce a value because of time decay, so that will be favorable to option seller, and option buyer would be losing the same amount. Now, options writing, you have to normally do it when markets are expensive, okay, or my VIX is very high, then you should go for writing. And if my VIX is low or my volatility is low, then you should look for opportunity to buy the options. Now let's see some features that discourages options writing. Okay, so one is, if you don't go with the insurance, then your risk is unlimited. So you have to be very cautious if you're just blindly writing an option. Okay, because risk is unlimited. Next disadvantage is that you can't think of any kind of lottery because your award is unlimited. Okay, so whatever premiums that you receive while selling option, that is the max award you should expect. And if you're writing option, then it's a business and you have to pay some capital, you have to use some capital, so the margins are required. So let's take example, if I'm buying a 10,000 call and its rupees last rate price is 100 rupee, assume. So to buy, I need to pay just 100 into 75, that would be 7,500. Versus if I want to sell the same option, then I may have to show around 60,000 in my pocket, then only my broker would allow me to shorter options. So you need a margin, you need some capital to do a writing. Okay, now let's go through the option premium. As I told you, we have to pay a small percentage. So that percentage that we use to do a transaction, that is known as options premium. And options premium consists of different values. So one is intrinsic value, and the second thing is known as extrinsic value. Okay, so intrinsic value is very easy to calculate. That is nothing but the difference of your spot price versus your strike rate, and whatever is left over, that we call it a extrinsic, or we call it a time value. Okay, so intrinsic value is the value which is associated directly with the difference between the spot and strike price, and versus whatever is extra, we call it a time value. Time value could be because of excitement in the market, could be because of news in the market, could be because of close to the expiry, maybe because of interest rates. So those are the factors that can increase my extrinsic value or can reduce my extrinsic value versus my intrinsic value. That's dependent only between the spot price and the strike rate, so that's very easy to calculate. Now let's see the example here. Now if you see the example for the call, the formula is spot price minus strike price. So in this example, if you see my 7500 as a strike price, and as my last price for the Nifty is 7730. So intrinsic value would be the spot price minus strike price. So that is 7730 minus 7500. So for 7500, my intrinsic value is 230, but the last rate price is 231 rupee and 05 paisa. So in this case, 230 is my intrinsic value, and the remaining 1 rupee 5 paisa is my time value. Let's take the example of 7600. So here my last rate price is 7730, so 7730 minus 7600, that's 130. So 130 is my intrinsic value, and the extra, that is 13 rupees 25 paisa, that's my time value. Also, if you're going for 7700, so in this case 30 is my intrinsic value and 35 is my time value. But if you consider out of the money option like 7800, so if you use the same formula, so that would be 7730 minus 70, so you get minus answers. So we generally disregard the minus, so in this case everything is my time value. So 19 rupees just a time value, there is no intrinsic value. Same if we're going for put side, so 7800, so the here formula is a strike price minus underlying price. So strike price is 7800 minus underlying, so in this case in this case 70 is my intrinsic value, and the extra, that is 18 rupees 20 paisa, is my time value. And for the OTMs, as you know, everything is just time value. So in case of in the money, we have two things. We have the intrinsic value plus time value, versus out of the money we will always have the time value. Same way in the case of put also, intrinsic in the money will have intrinsic value plus time value, versus out of the money will only have time value. So let's take another example here. So assume that Nifty is currently at 7710, and let's find out what is the intrinsic value and time value for 7750. As you can see, 7750 is in the white color, so there won't be any intrinsic value. So everything here, 38 rupees 35 paisa is my time value. Also in case of put, this is a yellowish color, it means it has time value plus intrinsic value, time value plus intrinsic value. So let's identify, calculate what is my intrinsic value. So 7750 minus 7710, that's 40 rupee. So out of this 5815, 40 rupee is my intrinsic value, and 18 rupees 15 paisa is my time value. And remember, time value will become zero on expiry in case market expires at the current price itself. Now we'll go to another topic that's called volatility. Normally I call it volatility, is nothing but it's a sentiment of the market. So if your sentiment is very high, then you would tend to pay more. So same way in case of my volatility of Nifty or underlying assets are high, then the premiums that you're gonna pay would be higher, versus if your sentiments are low, then things would be either discounted or cheap. So in case of volatility, we do have two different kinds of volatility, and one is known as historical volatility, and the other is known as implied volatility. As the name suggests, historical means past. Here, past could be maybe a 6 months, maybe a year. In R2, we normally consider past as a 1 year data. So, past 1 year data, we're gonna do some algorithm and we do calculate the historical volatility. So, we see in the last 1 year what was my highest historical volatility, what was my lowest historical volatility, and then we compare with the implied volatility, that is my current volatility. So historical means past sentiment versus implied means current sentiment. So current sentiment could be because of the current price of your underlying asset, maybe because of the implied volatility of underlying asset itself, maybe how close to the expiry or how far from the expiry, what is the strike price, and there are other factors like geopolitical news, or maybe central government news, central bank news. Those things would impact your implied volatility. So normally we compare historical volatility versus implied volatility to identify if my option premiums are expensive or just neutral or cheap, and based on that we decide if I should go for the credit strategies or I should go with the debit strategies. So our tools like Obstrator would help you to identify what is the volatility level, and based on that you could become a seller or you could become a seller with the cautious, or maybe you can become just neutral, okay, be a seller, be a buyer, or maybe you could be a just be a strongly buyer, or maybe a just buy with some little bit of cautious. Now we divide the volatility into these five different levels. Okay, so one would be very high, then high, neutral, low, and very low. So in case so my derivative market is showing me that we are currently in the very high volatility level, then in case I would be a very strongly a seller. If my volatility level is shown as a high, then we are seller, but little bit of cautious you have to be. In case of neutral, I could be a buyer, I could be a seller, but I have preferences here. So if I'm going for directional strategies, I normally prefer to be a buyer, and if I'm going for non-directional strategies, then I would prefer to be a seller. And in case my body level is low, then I would be a buyer, and if it is very low, then I will be strongly a buyer. Now there is a clause here that we will see how to use this one. So normally correct credit strategies can be permitted to higher levels, but there is no option for demotion. So you would say what is this statement in our workshop, you understand this. But at the moment just assume if you are very low, if my volatility is very low or low, you have to be a buyer. If it is high or very high, you have to be a seller, and if it's neutral, then you could be either a buyer of the option or could be a seller of the option. Now we go with the Greeks, and there are multiple Greeks in the market. Okay, in the options world, these are just top five that are commonly used. So one is delta. So easy way to remember is D for delta, D for direction. Direction means price can go up or price can go down. Okay, so just remember D for delta, D for direction. Then there's something called Vega. So just remember V for Vega, V for volatility. Volatility, as I told you, it is a sentiment. So if your sentiment goes 1% up or 1% down, then what is its impact on options premium? That is defined by Vega. Then theta means T for theta, T for time. It means if you stay in your options trade for one more day, how much is gonna impact you? That is can be calculated using the theta. And then gamma is nothing but it is like acceleration or rate of change of delta, or you may even call it a second derivative of price change. So first derivative of price change is delta, and the second derivative of price change is gamma. And finally we do have a rho. Rho is the impact of interest rates on your option pricing. So in case if your central bank changes the interest rates, it's gonna impact your options pricing. So how much it's gonna impact, that is calculated by rho. Normally we say don't be so sensitive about rho, because in India normally we trade options maybe for 1 month to 2 months, so don't be so cautious about rho. And in fact we recommend that in options oracle there is a filter rate option where you can actually write the central or the Fed rate, so maybe like a repo rate, but we normally say keep it zero for simple purpose. Don't be so cautious about those things because that's hardly impact us. So here the most important things are delta, vega, theta and gamma. So as you can see, rho is not important, so these four Greeks are very important for us. So one is delta. Delta means if my underlying price changes by a rupee. So if my Nifty goes 1 rupee up or goes 1 rupee down, how much my option premium would be impacted. That is defined or calculated by delta. Same way, if my sentiment goes 1% up or my sentiment goes 1% down, how much is gonna impact my option premium. That is calculated by vega. Theta, as I told you, if you stay in options for one more day, then how much is going to impact your option price. That is theta. So here I could have a positive theta, I could have a negative theta. Okay, so options buyers will always have a negative theta versus option seller will have a positive theta. And as I told you, gamma is a second derivative of price change. So if my rupee changes, my underlying price changes by 1 rupee, what is the second derivative impact of that? That is defined by gamma. Normally we avoid gamma trading. There are certain technical reasons are there. So in the workshop we're gonna inform you what is the exact impact of that. But generally we try to excuse gamma from the trading. We normally focus on delta, vega and theta. We don't want to get trapped with the gamma, okay, because gamma will have a bigger impact on the last week of the options expiry. So generally we try to avoid gamma trading or gamma scalping. So delta is nothing but it's a price change, okay, vega is a sensitivity level change and theta is a time change. Or maybe if you stay a one more day in the option, then how much it's gonna lose a amount or you're gonna gain amount, that is theta. Now before we go deep dive into Greeks, we need to understand what's the difference between theta and time value. I've seen that most of the people they misinterpret or mix up these two terms. So theta is nothing but it's a depreciation rate versus time value is a depreciated value. So in this case, if I'm in the option trade and if I move close to the expiry, then my theta actually increases, my rate of depreciation increases versus my time value actually reduces as you move close to the expiry. Theta is nothing but it's a rate of change, so it would be like a percentage value versus time value is a depreciated value, so it will be like rupee value or like a dollar value. So let's take the example here. Assume that you have bought a laptop, okay, and let's assume that laptop is gonna be with you for 3 years. So in this case the first day itself it's gonna lose nothing, so depreciated rate is 0, and assume the cost of laptop is 1 lakh, so my value would be 1 lakh rupee. End of first year, let's say we are saying my laptop depreciated by 20%, okay, so 20% is reduced, so in that case my value of the laptop would be 80,000. Third year it loses another 30%, so in that case my cost of the laptop is 50,000, and in the third year we're gonna reduce leftover percentage, that is 50%, and my depreciated value is 0. So here as you can see, as we move close to the expiry, my theta is increasing versus my time value is reducing. Okay, so now let's start with Greeks. So Greeks, as I told you, delta. So delta, this example is for long call. So delta normally we have a value from 0 to 1. So at the top would be uh, 1, and here at the bottom it would be 0. So if you go to the NAC page, the yellowish color, that would be 1. So in case of a call option, at the top is yellowish color, so it will start from the 1. At the center it will reach, that will be half, and as it moves out of the money it will go towards 0. So in the money it's between 1 and a half, okay. At the money, whether it is a call or put, it will be always half, and out of the money it would be from half to 0. So in this example or in this graph, as you can see, as price increases, my delta value also increases. Okay, so that's the same thing is written here. If my underlying asset price increases, my call delta increases. Let's take the example here. Let's take some symbol that is trading at 30 rupees. So at the 30 rupees, this is my ATM. So my delta has to be half, and in the money is at the top, so it will go towards 1. Out of the money is at the lower section, so that will go towards 0 here. Now the same symbol after few weeks is trading at 50 rupee. So 50 rupees is my new ATM. So in this case my delta would be half, and as we move up that's towards in the money, so it will go towards 1. As we move down that's towards out of the money, so it will go towards 0. So in this example you can see that my underlying value it increased from 30 to 50. In this case my delta value also increased, and it has increased for all the strikes. So initially it was for the 10 it was 0.7, now you can say it is 0.9. For the 30 it was 0.5, now it is 0.7. For 40 it was earlier it was 0.4, now it is 0.6. For 50 it was 0.3, but it is now 0.2. So as you can see here, if my underlying value increases, my call data increases. Similarly, you can say if your underlying asset reduces, then all the call data will also reduce. Let's take another example for put. Put is inversely correlated with the market price, so it will behave inversely. So in this case, if my underlying prices increases, my put data will reduce, or you may call it if your underlying prices reduces, then your put data will increase. Okay, so we'll not go very detailed here, but in both the cases you can see in the money it will be from 1 to half, out at the money it will be towards half, and out of the money it will be half to 0. This will have a negative impact because it's inversely correlated with the prices versus call. It will have be directly related with the price, so it will have a positive impact versus this will have a negative impact in case of price change. So here is a combined diagram of both. So as you can see here, that's for my call option, this one is for my put option. Summary is that in case of both call and put, if you are towards OTM it will be towards 0, if you are towards at the money then it is towards half, and if you are considering the in the money strikes that will be towards 1. Next comes Vega. Vega is nothing but that's a sentiment, and remember sentiment is always high at the current price because we are much more bothered about the money that we're gonna pay today, and current price means at the money price. So here you can say, let's take the example that this is my first commodity which is currently trading at 90 rupee. So at the 90 strike my sentiments are very high compared to my in the money strikes or out of the money strikes. Same commodity after a few days is trading at 100 rupees, so you can say the 100 rupee my Vegas are highest compared to in the money strikes or out of the money strikes. And after a few weeks again this same commodity is now trading at 110 rupees, so at 110 you will find the Vega is highest compared to in the money strikes or out of the money strikes. Now you can read it here. So Vega increases as the option moves from being in the money to at the money, where it reaches its peak, and then it decreases as you move towards out of the money strikes. Now next Greek that's very important, Greek is theta. Now question is why is theta in this diagram. So as you can see these curly brackets, those are nothing but those are my theta. Okay, so as you move close to the expiry my theta increases as my curly bracket size is increasing, you can see here, versus this graph, this curve that's going down, that is nothing but that's my time value. So time value reduces versus my theta increases as you move close to the expiry. So there are certain rules are there over here around this that we're gonna cover during our workshop. Okay, but just remember theta increases as you move close to the expiry versus time value reduces as you move close to the expiry. Now let's see a few examples here. Now in this option oracle screenshot you can see that underlying symbol is Nifty. Currently it is traded at 7738, so 7738 would lie somewhere here, And type, you can see everything is called here. In this example, the white colors are my in the money, this gray colors are my out of the money. Now at the money, as you have learned earlier, my delta is towards half, so same way you can see here, this is my delta, and at the money it is nearby half. As we move close to the in the money, it goes towards 1, and as we move towards out of the money, it goes towards 0. Vega, we have done that it is highest at the money, and the same thing you can see here. So at the money, the Vega is highest, and as you move towards in the money, it reduces, and even if you move towards out of the money, it reduces. Theta is long because this option, or I can assume this is a long option, so it's showing all my theta in negative. So let's take the example of 7700. So currently it's trading at 183, and the theta for today is minus 2.945. It means today is gonna reduce 2 rupee 94.5 paisa, and tomorrow is gonna reduce much more than 2 rupees 94.5 paisa. Similar examples is here for put options, and you can see everything is put here. So these colors were color changed, those are my at the money option, and at the money option you can see my delta is towards half. As you move towards in the money, it goes towards 1, and as you move towards out of the money, it goes towards 0 here. Vega is always highest at the money, as you can see here, and if it goes towards in the money, it reduces, and if you move towards out of the money, it reduces. And theta we assume minus, and that's a minus sign here, so it's going to reduce this much value from its last traded price, or maybe of the price that you have bought. So it's going to reduce this much theta today. So with that we end all our Greeks. So the most important Greeks are delta, Vega, and theta. So delta is basically a price change impact, Vega is sentiment change impact, and theta is time passing impact on your option premiums. Now if you're trading options, you need to understand what's your support, what's your resistance. Even if you're trading a delta neutral strategy, so you're trading a non-directional strategy, so you're trading a bullish strategy, so you're buying strategy, you should have a basic understanding of support and resistance. Although we don't cover this topic in very deep dive, but you should have some understanding. All the our tools on like option or like advanced, that will help you to identify your support and resistance. Now generally people will have one single line at the top and they call it a resistance, and they will have one line over here that they may call it a support, but we normally prefer to play in the zone, so we try to add two lines at the top and two lines at the bottom. So one would be a resistance entry line, another would be a resistance stop loss line, a stop loss line. Same way we have a support entry line and support stop loss line. So if market moves very fast at my resistance entry line, I'm ready to short in the assumption that market will go down. But in case market continues goes up, then at the stop loss line I'm going to quit the trade. Same way here, if market goes down pretty fast, so at the support entry I'm ready to go long, but in case if market continues going down, then at the stop loss line I'm going to quit the trade. Now how to identify support and resistance? There are different ways to identify your support and resistance. You may use candlestick pattern if you're comfortable, or something like a double top, triple top, doji candles, morning stars, evening stars, blah blah blah. You may use indicators like moving averages or Bollinger Band. You may use oscillators like MACD, CCIs, RSI, and other indicators. You may use simple things like swings high and swings low. So in a chart on the longer time frame, you may say swinging high and swinging lows. That can be considered as support and resistance. And there is another not a good method as using the pivots. So you may use R1, R2, R3s, or maybe S1, S2, S3s, those things. But we normally recommend to avoid pivots. Then you may go for price actions like pure based on the candles, how fast it moves up, what is the size of candles, and there are different ways using that you can trade. In fact, I normally prefer to follow the price actions. Then you may use standard deviations, and our tool option oracle would help you to calculate the standard deviation based on how much time is left. So it will tell you some range, and you may use those range as your support and resistance. Then in the workshop we're going to see option oracle advanced version, and then in the option it does shows if you click on the put call ratio, it will show you the OI analysis, and you think that it will give you some support strikes and resistance strikes, and believe me, those are very good precise levels. Okay, and normally I follow even those analysis. And in the workshop we're going to see how to use ATI. I'm not going to touch that topic, but in the workshop we do touch ATI. Using ATI we do identify what's my support and what's my possible resistance level. Now we will go through some common terminologies that is used in the options world. So credit strategy is one of them. So it says credit means where we are receiving a money. Okay, so few strategies that are like a credit strategies, like short triangles, short straddles, iron condors, iron butterflies, maybe a short put, short call, or maybe bull put spread and bear call spread. Yeah, so those are credit strategies where we actually receive money or we receive premiums. Debit strategies are the strategy where we pay to buy something. Okay, like a long call, long put, or maybe a long long straddle, long triangles. So those are my debit strategies. Then people do use vertical spread. That means something up and something down, like a bull put spread or bull call spread. So those are vertical spreads where we are buying something, we are selling something. So I may go for long 10,000 call, and I may go for short 10,500 calls. So that is nothing but that's my vertical spread. Horizontal spread means we are talking about the same level. So a few examples are like calendar spreads. So let's take the example like 10,000 call I'm shorting for this month. I'm going for 10,000 call for the next month. Okay, so that would we will call it a horizontal spread, or people may call it a calendar spread, or they may even call it a time spread. Then there is something called a diagonal spread. So diagonal spread is nothing but just mix of a vertical spread and a horizontal spread. So let's take example of a vertical spread. So 10,500 call I'm going long, and 10,500 call I'm going short. But in this example, if I mix up the months also, so I'm going short for current month, I'm going long for next month. So that would be known as diagonal spread. Ratio spread means why we are buying something one and we are selling something twice, or we are buying something one or selling something in ratios. Okay, so that will be known as a ratio spread. So there will be some ratios based on your magic numbers. You may have ratio 1:3, 1:7, 1:5, and so on. Then there's something called vertical credit spread. So this is nothing but a vertical strategy, but where you're going to receive some monies. Same way a vertical debit strategy means something up and something down, but you're gonna pay a premium for that. So vertical credit examples could be like your bull put spread, and your vertical debit example could be a bull call spread. Then there are a lot of guys they do a data neutral or bricks based strategies. They may go for data neutral or gamma neutral. So there they try to keep the data zero as possible. So in option oracle, if you see total data in the strategy, it will show you 0.00. So that means data is zero. So if you go to technical definition of data, it means if prices goes 1 rupee up or go rupees 1 rupee down, you'll have a zero impact on your option premium. But remember, option data keeps on changing on everyday basis. So initially your data could be zero, but later on it may gonna change. So a lot of guys they do a trading using data neutral. Remember here it requires a higher fund, huge amount. Okay, capital is required, but this is a high probability trade, but it is less rewarding, and it may require adjustments. So you need to have a certain capital free so that you can do your adjustment of your trades. So that's the terminologies. These are the few questions that you can try, and if you have enrolled for my workshop, then you need to reply the answers for these questions. And if your response is correct, then I'm gonna share you complete modules, study materials for the workshop. So with that, we end this section, and hope to see you in my workshop. Thank you.